Welcome, ladies and gentlemen, to another issue of the Grey Market Talk with my fabulous guest, Nick Themistocles. And today we do something different. I want to talk about a topic, Elliott Wave Analysis, and I have an expert here. Nick, you are CFA. I've looked that up. Is that a chartered financial accountant? You have a lot of letters behind your name.
It is a chartered financial analyst, but that has very little to do with Elliott Wave, other than there is an Elliott Wave qualification in my sort of letters that I have.
What are the letters for the Elliott Wave thingy?
So the Elliott Wave thingy is CEWA, which is Certified Elliott Wave Analyst.
And for how many years are you doing that now?
Well, I started Elliott Wave in 1993, right when I was a trader at JP Morgan. So that's 30 years now. That's 30 years.
I was still at university in 93.
Yeah, well, some of us were working. So I was at JP Morgan at the time. I realized that I had to do something because macro, which we all did macro at the time, it didn't help you at all with timing. So I needed a timing tool. So I stumbled more than anything over Elliott Wave, and then I sort of did a course in 1993 with the Elliott Wave Institute. I've been with them pretty much ever since. The founder of that institute wrote the famous book, and that's you must drop something here. I don't know if you can see that. You probably can't see that.
Wait, hold it down a little bit. Yeah, now we see it.
Right.
I have Frost and Pressure. I have that here as well.
So Prechter was the guy who founded this institute. And there's a sort of a picture of him and AJ Collins. You can see that. But anyway, this book, I've got about 6 versions of this book. And the first version, it hasn't really changed much, but some things they've discovered new things, or they treat things slightly differently. Generally, this for me is always on my desk. I mean, I've been doing this thing for 30 years, and I have a screen and I have this book. This book is an amazing kind of Bible to help even somebody who's been doing it for so long stay on track with the Elliott Wave.
So what we're going to do today is obviously we want to have a look at 2 major markets, the S&P and Bitcoin. We have new all-time highs, at least in the S&P. Did we have a new all-time high in Bitcoin, Nick?
We have had an all-time high, but we've come back from that all-time high.
So not recently, not last week or something like that.
Yes, absolutely. 73 or so thousand was Bitcoin, and then it went down to around 60,000. It's about 65 today.
So we are in uncharted territory, at least on the S&P, and I find that always very interesting, because a lot of the conversation I have with students, and pretty much every volume tells you where markets are going, and it's good to have a footprint in the market of past volume. When you enter new uncharted territory, you don't have a volume footprint anymore. So it's an educated analysis, guess, where markets might develop, in which stage we are in. And let me come back to Elliott Wave, what it actually is, Al. We know Elliott Wave is used in the market by professionals like you to make estimates about where are we in the current cycle. What's the logic behind it? Why does it, and I've seen it many times in progress working, if you get the wave count right, what is the foundation of the whole Elliott Wave principle?
Yes, as you say, it's a roadmap. And how does that roadmap kind of come about? It comes about because when you and I as individuals bet on prices or we value something, we value it as an individual, and we put our own analysis. But when more than when a group of people come together and they all bet on prices, the way that they behave is not random, but is actually in accordance to certain patterns. You can imagine, there are some birds, the feathered kind, and then suddenly there's a noise, and then the birds fly off, and they all fly off in this beautiful, what looks like a sort of a very clear pattern all together. How do they know that? And if you can imagine when traders have their screens and they can't see all of the other market participants, but every market participant can see the price, they all behave in a certain way, in what looks like a very predictable fashion. And what Elliott Wave, the guy who discovered Elliott Wave, Ralph Nelson Elliott, about 100 years ago, he realized that there were certain patterns. And remember, when he did this thing, he didn't have tick charts and he had line charts, and he created rules, and then Frost and Prechter kind of updated those rules, in accordance with bar charts and things like this. And so the fundamental basis is people act together in a form of a pattern. And those patterns, there are a certain number of patterns, and there are 5 patterns, and there are only 5 patterns. 2 which are sort of going with the trend, and 3 that go against the trend. And there are rules, and there are about 100 odd rules and guidelines that you have to, and that's why, because there are so many rules and guidelines, you need this book with you just to keep you from making what I see so often with Elliott Wave Analysis. When I look at YouTube videos of this chart and that chart and whatever, I'm looking at it and there are sort of lots of numbers and letters and things like that on the chart, but I don't recognize it. It's not Elliott Wave, and what people are doing is kind of, it's misleading in a way. And I think in order to do this thing properly, you've really got to study this thing. You've really got to spend some time. There are some very good analysts, but there are also some things which are not really Elliott Wave, but with letters and numbers that come under the heading of Elliott Wave, but it's not.
So it's a summary of the market psychology of the market participants, which expresses itself in the analysis of the waves, and the psychology of the market participants is actually based on all sorts of information we discuss every week here: fundamentals, technicals, what the market in general is doing. So and you correct me if I'm wrong here, you could see that as a standalone solution or as a supportive tool for what we are doing week after week here, Nick?
So when I started Elliott Wave, obviously the first thing I learned was, like everything else, you learn about how the markets work. When interest rates go down, you look for non-farm payrolls, you look for all of this stuff. And it became very, very clear to me that this stuff was not a timing tool. This stuff was good to know. It was an orientation of what you think about the market. But as we discovered last year, even the experts had an orientation about the market that was totally wrong. The market's going to go down, they said. There's a recession, they said. Well, if that's the case, how do you avoid, as a trader, sort of not just being short the whole time? Obviously, you see price action, and that price action forces you to do things. You see Nvidia going up, and you think it's overvalued, but people are still buying it. And it's this herd mentality, if you like, this psychology that's kind of driving the prices. And it's good to know what the roadmap looks like in advance so that you can orient yourself. And the great thing what Elliott Wave does is it is used together with Fibonacci analysis in order to provide some mathematical basis for providing targets, for providing retracements, for things like this. And so when I first used this thing, I used it as a standalone tool. And as a standalone tool from 1993, when I was running European governments at Dresdner, it was the most valuable thing to help guide me and the risk of the desk. It was a phenomenal tool. And yet I found, other people who were looking at, the dollar and the yen and all of this stuff. It was not very helpful for timing. So I found this a very, very useful thing.
So you were running the market making unit at the time for Bunds, right? So
yes,
a lot of day-to-day trading going on. I'm usually focused more on the medium to longer term, and Elliott Wave seems to give supportive indication about that. At least when I look into your analysis, it always gives a very good guideline or roadmap where it's going. As I'm not active in day trading, and my market making on the equity side was a little bit different than what you had on the bond side. So you used Elliott Wave to give you guidance during the day while trading bonds, putting on hedges, being aggressive,
Absolutely.
being less aggressive.
So when I was chief investment officer, as I got older, of course, you get less and less into the day trading, and you're looking more for the bigger patterns in the market and the themes in the market and things like this. But when I was running risk, this was where I used Elliott Wave probably the most in my career, was when I was running the risk at Dresdner. And you can imagine the swings in the market are very big. And as a trader, you have certain limits of how much risk you can take. And obviously, as a trader, you don't want to go to your boss and say, well, I've lost £1 million today. So you have to sort of use this tool for stop losses. And that's the other great thing about Elliott Wave. When you're wrong relatively cheaply. But yes, I had tick charts in front of me, not just minute charts, 5-minute charts, 30-minute charts, hourly charts. But yeah, I mean, when I was really looking really deep into, I'd go into the very, very minutiae of what was going on and saying, and the great thing about bunds in those days, we were trading, I can't remember, million contracts a day. There was enough psychology in the price that this thing could behave in a way that was more in tune with the rules. And so you had less noise. And if you go and use Elliott Wave on a stock with very, very few participants, there's almost certainly more noise than there is signal. And that's what you want to try and avoid. And sort of, but there are enough stocks and instruments out there that have enough volume, and that's really important.
One last question. If Elliott Wave gives us good marks, where to be careful, where markets could move into which direction, especially with Fibonacci, where could we see retracements, what is the extensions? You'll go into it all when we're looking at the S&P and Bitcoin. The algos are dominating the market for a couple of years now. Is that programmed in all these points, all the analysis into the algorithmic trading programs as well? Because I've seen on TradingView, and you were sniggering about that. Every time I put it on, there is a beta function for Elliott Wave, which automatically prints it on the chart. And you've criticized that many, many times. But what went through my head is, obviously, if a model gives you signals and the guys who want to trade the market automatically through algorithms, well, I would program that in, so it could become even more a self-fulfilling prophecy. Am I right here? Are you seeing that in the daily chart patterns, that it follows Elliott Wave, that the machines are at certain points where Elliott Wave indicates are becoming more active?
No, I think not necessarily Elliott Wave, because it's a very difficult thing truly to program. And I know that the Elliott Wave Institute run their own program, which they've been, I don't know if this is still a beta thing. It's called E-Waves. And they keep it kind of to the side to confirm what the analysts themselves are interpreting on the day. But, I had a conversation on this just the other day. I think the algos are more about possibly fib retracement. So the part of the Elliott Wave where algos probably do count are Fibonacci points, but it's more about moving averages, more about crossovers. How sophisticated these things are, I honestly don't know. There are so many tools, cycle tools, moving average tools, momentum tools. I honestly don't believe the market all follows one particular thing, but what the market has, which is sort of fairly ubiquitous, is the fact that everybody has the same psychology. The people behave according to patterns, and so a good analyst will, on the whole, make more good interpretations than bad interpretations. And as we'll see, an interpretation on Bitcoin or S&P or gold or whatever, there is more than one way to interpret it. And that's the important thing, is to understand, okay, which way obeys the rules. That's very important. Which way has the right look to it? Is that, am I just sort of putting numbers on this thing? 1, 2, 3, 4. Oh yeah, I've counted to 5. That's it. Got to sell this thing. That's not enough. So there has to be something else. And, the more you do this thing, the more you learn the tricks of the trade. And as I say, the beautiful thing about Elliott Wave is that it points to not just a roadmap going forward, but if you wanted to look for trade entry points, especially for day traders, there are certain points on an Elliott Wave pattern where you would say, here is a low risk entry point. And that's something that becomes very, very interesting to say, okay, here's my low risk entry point. And now I if I want to buy a call spread or whatever it is, because I think this is, the trend is over, I am looking for a certain target based on a Fibonacci extension, and the confirmation will come when I break a certain level, and those things we'll learn. But it is so standalone. You can use it standalone. And I'll tell you, sometimes I get more confused when I look at other things. I was really good when I just, it was the good old days when I had my CQG system and only looking at Bund future. And now there's many instruments and many things you can look at. And that sometimes does get confusing.
Yeah, see, I always had the advantage as a market maker for options. I believe in randomness. I have to believe in randomness. So, but I know already there will be a lot of questions, especially from my students, about the day trading applications. We're not going into that today, obviously, but what we are looking into, and obviously then I would kindly ask you to share your screen. Where shall we start, Bitcoin or S&P?
I don't know, let's do Bitcoin because it's probably trading today. So I need to find the share screen. Here it is. Share screen. I'll just do my desktop. So you'll see
Bitcoin on the screen. Thank you, Nick.
Okay, right. So, so where are we starting from with this chart? We're starting from a low, which I've labeled here green 4, which may or may not see.
First question, how do you choose the low? We need a starting point.
So absolutely, that was asked at your course. Actually, Marcus asked me, where do you start if you want to, chart oil? Where do you start? And you have to start at significant, highs and lows. So if I sort of go into now a weekly chart on Bitcoin, you can see it's loading. It's very slow. Okay, whilst it's kind of thinking about it, you do pick highs and lows. So this November 22 low was the significant low. And here it is down here. So I'm starting the analysis by saying, okay, there was some, this is the history of Bitcoin and, 1, 2, 3, 4, and so on. And you've got this corrective pattern. And corrective patterns, you could identify this as a, ignore that it's a 4 for the moment. Doesn't have to be, but it's a corrective pattern. I've labeled it as a 4. It's a conservative measurement. So by saying it's a 4 rather than it's another 2. So I've got this thing as a significant low, and I'm saying, right, I know it's not a significant low if it overlaps that 1. So if I'm counting it as a 4, the rules of Elliott Wave say that 4s can't overlap wave 1s. We discussed that a long time ago on the S&P with this 4,100 and 4,103. That was a wave 4 versus a wave 1. So we've got a similar situation here. We've got a significant low. So I'm saying, okay, if this thing is going to bounce from here, then I want to see some kind of bullish price action.
Let me quickly ask another question.
Yeah,
so the C or the 4 right here, your significant low, has to be lower than the 1, which was a temporary reprieve in the previous wave, right?
So where is which one are we?
Yeah, the one.
This one?
At 13,868. No, to the left.
This one.
This one.
So this 4 is not allowed to overlap wave 1.
Wave definition of overlap would be if they are at the same levels. So when the former resistance becomes a support, or
perhaps the easiest thing we start instead of jumping into a pattern very, very quickly for everybody, just a rule thing, or let's just quickly go through some patterns. I think I might have it. Must have it somewhere here. Yes, here. I did this earlier. This is something I produced earlier. Right. So 5 waves is the Elliott wave pattern. 1, 2, 3, 4, 5. And you can see that wave 4 does not overlap that wave 1. The only time it's allowed to overlap is when you get something called a leading or an ending diagonal triangle, which in normal charting terminology would be like a wedge-shaped pattern. So wedge-shaped patterns, I could draw one very quickly, leading diagonal. Let's just do that. So here's a wedge-shaped pattern. You can see at the bottom, you can see 4 overlaps, and there are certain rules as to what these substructures are allowed to look like. We don't need to worry about that. It's at the wave 1 position, the wave 5 position, you get these types of patterns, these wedge-shaped patterns. It's the only time where wave 4 is meant to overlap wave 1. But in the normal, what's called an impulse wave, a wave in the direction of travel, the normal wave is an impulse wave without the overlap. Here's the leading diagonal or the ending diagonal. This is just the normal impulse wave, no overlap. And you can see each of these waves have subwaves, and that's this chart here. So that wave 1 has 5 waves, that wave 2 has 3 waves, that wave 3 has 5 waves, so here's the 5 waves here. That wave 4 has 3 waves, that's the 3 wave here, and that 5 wave has 5 waves as well, subwaves. And these corrective patterns like this could look like a triangle, could look like this thing up here, could look like that up there with a kind of, so those are the types of patterns that are allowed within the Elliott wave system. As I say, there are 5. So there are 2 that go in the direction of the trend. That's the leading triangle, the leading diagonal or the ending diagonal versus the normal impulse wave. Or the corrective patterns are triangle. This is called a flat, either like this, or like that, or it's called a zigzag, where it's sort of pretty much shaped like, if you like, sorry. That's a zigzag type pattern. So those are the 5 waves that are allowed. And that covers everything that you will see in the Bitcoin chart, which I'll go back to. It was this one. I think it was this one. Right. So there we were, wave 4. This is a normal, I'm counting this thing as a normal impulse wave. So normal in the direction of travel, I'm saying is up. I'm saying that there was a significant low here. From that low, I can count 1, 2, 3, 4. It's a bit of an extended 4, in terms of time, in terms of distance. And then from here, we have an impulse wave going up. And this is what I'm counting. And so if I go back to the daily chart now where we were, and we come back to say, okay, that was that 4 that we saw earlier, which was higher than the wave 1 position. And what happens since then? So I just widen my screen. What's happened since then? We've had a 5-wave move. We've had some kind of correction. We've had another 5-wave move. We've had some kind of correction. We've had some kind of 5-wave move. We're having some kind of correction. Correction may be over, maybe not. And the trick about Elliott Wave is, or the obvious question is, okay, if there's another Elliott Wave guy, would he label that chart in that way? You can see a 5 and a 3 and a 5 and a 3 and a 5. Would he call it 1, 2, 1, 2, 1, 2? Maybe not. Maybe he'll do something like this. Again, we are at that wave 4 low. Maybe he says, well, I can count 5 waves here, and I can count another wave here, and then I can count 5 waves here, and then I'm sort of looking in my roadmap for a bigger correction here. Okay, what about another Elliott wave?
Let me interject the question there again.
Yes, go on.
The longer you do that on one chart, do the patterns with time become more reliable? Is it the character of one chart that you can always work with? Not the same, it's never the same, but a similar projection of the wave pattern you have established over the history?
So the target points and the corrections, you can see that I don't care what happened before that, except when it comes to the previous wave down, which was this November 21 high. The move from November 21 right up to November 22, a 12-month movement, gave me some information. And it basically said, okay, this move up here could have just been one of these corrective patterns, and then the whole thing collapses. And obviously, I'm saying, okay, there's an entry point here at 4 because it's fallen to 50% retracement. It's a reasonable retracement level, reasonable support. And I know that it's not allowed to overlap that wave 1 that we saw below. The wave 1 was at the point we said was, I think you said was 13,000 something. So here is a point at 15,000. I know it's not allowed to overlap 13,000. So I can buy the position at 15,000 and say, okay, I've got a 2,000 stop loss here. And I'm now betting on this thing to go up. And then we look at retracements and we say, okay, the previous histories helped us. So let's look at the retracement now. So the thing has started to move up. And the moment this thing passes a Fibonacci point, most people know 61.8. The square root of 61.8 is 78.6. So once it passes the 78.6% retracement level, and you can see the thing paused at 78.6. I mean, these are not sort of made up numbers. If it breaks 78.6, then there is a kind of a knee jerk. Where's the market going? What's the first target? And the next target is this 1.236 or 1.272 and 1.382 extension of this previous wave. So you can imagine, as an option expert, you'd say, okay, you could either be taking an option position down here, looking for a retracement to the 61.8, 78.6 range, or once it breaks 78.6, I could be looking for a trade to go into a bull call spread, if you like, into the next target level. So that's how history kind of helps what we're doing now in terms of building the pattern and building the roadmap. But as I was saying, I've got these sort of boxes here, and these boxes kind of mean something because part of Elliott Wave is all about the right look. And, the problem with this particular chart is a bit geeky, is to say, well, look, I've counted 1, 2, and then I've done 1, 2 again. You're going to say, what's wrong with that, Nick? And I say, yeah, that's fine. But this 2 retraced almost 100% of this wave 1. Whereas this 2 only retraced about 25% of wave 1. Are you sure about that? And I'd say you're right. That's not a good count. So then this is all about how an analyst becomes a good analyst and what you need to look for. So we're back to that wave 4 low. And we still count this sort of 5-wave pattern as a wave 1. And now instead we broaden out wave 2 and we say this is a 3-wave pattern. Clearly it looks like a 3-wave pattern. That clearly looks like a 5-wave move up. So 3 waves are the corrective patterns. These are great entry points because once you see 3 waves, you say, oh, there's a good shot here that I could buy this thing perhaps, why not? And then you go up, and then I see a corrective pattern here. And I say, okay, how big is that corrective pattern? And in the future, I want to see a pattern that is of similar length, similar kind of, it might have a different shape. And actually there is a guideline which says it almost more often than not has a different shape in terms of the type of correction. But I'm looking for a pattern of similar length. So if this thing here becomes of similar length, then I know that this 1, 2 means at that point there was not a green 3, but rather a red 3, because red 3 and red 4 should match red 1 and red 2. And in the same way that here I'm calling this thing blue circle 1 and blue circle 2, I'm looking in the future for blue circle 4 to have a similar kind of length, or, perhaps not necessarily length in time, but in addition, perhaps a much sharper move, corrective move. And so I'm looking at these things in advance to give me confidence about what the wave pattern looks like. So here I am with my preferred outlook for Bitcoin. And I'm either toying with the idea of saying that that's probably a red 3 and we're looking to do a red 4, or we're still forming that with a new sort of mini high before we see that deeper correction to and here's the other thing about, beautiful thing about Elliott Wave is that wave fours or corrections tend to go in the wave four of the previous low, of the previous wave of what's called one lesser degree. So this wave four, if you like, is falling within this wave four here, but you can see because of the length of this wave four, I'm saying that there's another wave four to come, much bigger, because this is not long enough. I can't match it with this. So that's why I called it green. You know, maybe we get another higher, and then we get correction down to 4. And I'm looking for this recovery or this ultimate target for Bitcoin for this 1.272 to 1.382. And 1.272 is the square root of 1.618. So that's where these numbers come from.
Practical application in this corrective pattern we seem to be in at the moment, which if you projected with a purple box.
Yes, we may not be in it at the moment. We may be doing green 4, then going to green 5, and the purple pattern would be red 4. And if we elongate this pattern a little bit, this green starts to take on a longer shape, then I would relabel that a red 3, looking for red 4, because it would imply that these two things are more similar. This is about sort of having the right look. It's a bit sort of deeper sort of teaching of Elliott, but you know, when I go through the S&P, you'll see why I do this kind of stuff, because it helps to keep me on track and avoids me doing silly things, just putting letters and numbers and letters and numbers. They've got to have some resemblance to a previous wave.
So if I want to look for an entry, I must not undershoot the green 4 right in front of the purple box.
Let's go back to this. I don't know if this is a good chart to look for. Why not? We said green 4 was a good entry because it was a 50% retracement. We go back to this thing where I had the Fibonacci points, and I think I had green 4 here as 50% retracement of the previous wave. Here's the 50%.
No, I was talking about the Roman green 4.
Oh, the other green 4. Sorry. So
right, yeah, exactly. So because the idea, if and you correct me, obviously I'm wrong. I'm not an expert. I'm not even claiming to be. I was just thinking if this up move pattern is intact, and I don't want to I do not want to undershoot the green 4. Because then I would go in and say, fine, obviously we will be taken up to the 127.2%, which means I would buy a digital call spread at 95 for pennies in the dollar and would make a fucking killing if the move takes us to this level.
So that's exactly with options, how you use Elliott Wave. You look for generally you can try and pick the highs and the lows. All right, we know what I mean. I've probably lost most money picking highs and lows. You know, this is the end of the Elliott of the S&P. This is the beginning. You know, you need to have some point where you can say, okay, have I got a cheap stop, or do I just sort of say, okay, I bet, you know, X thousand or X percent of whatever I want to bet. Generally, the great entry levels are wave 2s and wave 4s. Generally, there are rules about how deep a wave 2 is going to be, and you would normally see wave 2s in normal market conditions retracing between 50% and 61.8. This is a very narrow wave 2, which questions, is it really a wave 2? This is a narrow wave 2. And a wave 4 retraces generally 23.6 to 38.2% of a wave 3. And when you know those relationships, you look for entry levels and you say, okay, I take a bet here, and what I'm going to do, and I have to probably do this with a chart in front, otherwise it's a very, very difficult thing to show. You know, maybe I can just quickly do that with just putting a chart here. So here is my wave 1. Here is my wave 2. It's reached 50%. I'm thinking, okay, is this a reasonable level to buy? do I see wave 4 as being a three-wave pattern? So let's just add these lines, show lines. So do I see a three-wave pattern? And after I see a three-wave pattern, and a three-wave pattern and wave 4 finishing off roughly in the 50%, 61% level, I might say, okay, let's buy this thing. And what am I looking for? I'm looking for a rally to, and this is the next point, a retracement of that move. So what am I looking for? I'm looking for a return to somewhere between 38.2 and 61.8%. So I'm buying something here at 23,000 and I'm looking for a recovery to between 25 and 27,000. That's my bet. That's my kind of call spread, if you like. You can use 78.2 as a target as well, but that's your first bet. Once it goes past the 78% retracement, you're now looking for a Fibonacci extension. This is really getting into, this may be getting very confusing for people, but I'm going to try it anyway. So once it's broken this 78% level, you're now looking for a target up to 123 to 138. You now sort of have a position here after you've broken, you're now looking for the next target. And that's basically all you're doing all the way along until you play wave 3 and then wave 4 and so on. You play 4 in the same way that you've played 2. You're looking for a narrower correction. We're going to see that with the S&P with some different retracements, but that's the idea. And, you know, as I said, my gut feeling on Bitcoin, firstly, in terms of, you know, ultimate targets, I've got 1 here. 1 implies that there's a 2 and then there's a 3 and 4 and 5. You can ignore those sort of bigger things, but ultimately I'm looking for some kind of retrace or some kind of ultimate target to between 103 and 122,000. And I think, you know, at that point, you're good. And what's going on with Bitcoin right now on the cycles, the cycle patterns on Bitcoin, this is S&P, cycle patterns on Bitcoin are a bit toppy. This is the daily, this is the weekly, and it could be that we start to see some correction. But remember one thing, cycles, if you're in a bullish kind of overall cycle, this thing could just be sideways, even though the cycle pattern says there's pressure down. Pressure down just stops the bullish market from going up. It doesn't mean it goes down, and ignore the amplitude here. That doesn't mean where the price projection is. But generally, I use cycles to help me with timing. So I'd say, is this a good place to buy Bitcoin? Probably not. The cycles are a bit toppy. Maybe that means we go sideways. Maybe I sort of pause and wait for the correction to be over before I look for the next entry level, you know, aside from the core position that I'm running. That's Bitcoin with a little bit of Elliott teaching. And I know it's very difficult. It is a very confusing thing, and you have to do it you have to learn it to do it properly. Any more questions on Bitcoin?
Yeah, again.
I'm going to ask another one. I'm actually going to go through another thing. Yeah, go on.
Always digging for a trade at the level we are at the moment.
Yes.
I agree with the cycle you just put in front of us. So what is the level I'm looking in at the moment if I think the long-term prediction of over 100,000 in Bitcoin is correct? Where would I buy? Where would I put a buy limit in to say, yeah, if we are at this level, I can put on a high, low risk, high reward trade?
So, I mean, the last entry level was this green wave 4. And the question is wave 4 over, or is it still continuing? And if this is a correct evaluation of what wave 3 looks like, yeah, so this is how I'm calling a wave 3 of, let's just say this is going to be the whole of the red wave 3 and not just green 1, 2, 3. Then I'm looking for this thing to go no lower than between 63,000 and 57,000. So somewhere in that range, I want to buy it after seeing a 3-wave correction. So did I see a 3-wave correction in that sort of green wave 4? If we go to let's just say a smaller chart, I don't know if this thing will give me, yes, it does. Cool. So This was the wave 4 low, and this was the wave 3 high. So do I see 3 waves here? Can I count 3 waves here? And I think I probably could. Yeah. So I could say 1, 2, 3, there overlap there, 4, 5, some kind of correction, then 1, 2, 3, 4, 5. So possibly a 3-wave is confirmed. Can I see 5 waves up now? If this thing was a low and a place that I should be buying, because it's in that range, there's 23%, 38%, I need to see 5 waves. Can I see 5 waves? Actually, be honest with you, it's very difficult for me. This is not a slam dunk, because if I see the move up here, I see 1, 2, 3. I don't see 5. So for me, this is not an obvious thing to say wave 4 green is over, or maybe we're doing wave 4 red. So, many things have to kind of fit into the pattern. If I didn't know what was going on after the wave 4, I'd be buying this thing here because it was in the range, 3-wave pattern over. But when I'd seen this, and then I'd seen this overlap here of, 1, 2, 3, and then this overlap, the correction is too deep. So I need to be looking for something which confirms to me that the correction is over. But from a Fibonacci level, you're in that range. And so this low risk bet, if you like, tells you that as long as you don't have that overlap, you are relatively safe to put on a trade. But where is your stop loss? And that's the most important thing. So you bought this thing at wave 4. You said, okay, I expect this correction 23% to 38.2. So you could have a stop loss below that 38%. First thing. From an Elliott perspective, you only know you're wrong when you cross wave 1. And that's too far away. You're not going to wait till 43,000 to buy it here. So therefore, you have to provide some sensible stop level. And that's why the 38%, a little bit below that, is a reasonable stop level. And that's what I would generally do. But at the moment, there is nothing to confirm to me that this wave 4 is over, or perhaps we're doing red wave 4. And that's the important thing is if you want to buy something, you want to see some confirmation of it. And at the moment, I don't see it. I just don't see it. So it may well be that this is still, finishing off somewhere here.
Yeah, but I think that's also the point which separates institutions, or so-called, I hate that, smart money from dumb money. As a retail trader, you want to buy something now. Yeah? What I'm trying to put out now is simply to say, well, fine, chill, wait. Where would be the point when I say I can rely on that the correction is over? I want to put my buy limit down here somewhere. If we reach it, fine. I know I have a good entry. If we don't reach it, I don't have to play with the fire right now. If I don't get this trade, there will be another trade coming up. But that's where I would actually position myself to say, fine, if we make this correction, this corrective pattern to the downside, we're not undershooting the level you're saying, fine, that I want to put in a long position. Not right now, when we are in no man's land.
Yes, this very important for me is, it's done everything it should do. It stopped at the right point. But what it didn't do for me is confirm to me a clear 5-way move on the way up. So I'd want to say you're in the range for where you should be buying it, but you need to see some kind of confirmation in the pattern that this whole corrective move is over. And it could be forming a more complex pattern. And, very important that you wait for these confirmations. And then what would you do? You'd wait and you'd say, okay, a final confirmation would come when we break the 78.6% level. So when we break this level here, up here, so let's just say you missed it. You counted, you weren't sure. Yes, okay, what do I do? You'd wait for this break towards the 78.6, and that would target for you this 138, 123 to 138, 127 to 138 target level. That's the sort of 77,000 to 80,000. These are small moves each time. It's still a 10% move. Still a big move, if it was a stock. But this would be a good confirmation that this correction is over. And then you'd have to say, okay, what did I miss in the count? Why did I not see that this was an ending count? What was wrong? What did I do wrong? But at the moment, I just don't see it. So I would pause, wait for some kind of confirmation, and price action confirms usually, perhaps we're forming some kind of triangle. Yeah, that's still possible. But once we break the 78% level, then you're probably more confident that whatever this correction pattern was, remember there are 3 different types of corrective patterns, whatever type it was, then it's most likely to be over, and it's most likely then to be targeting this kind of extension level, which we'll talk about here. So last point to buy it will be 70,800. If it does go up there, if it breaks this level, holds above this level, that targets this kind of 77 to 80,000 roughly level for Bitcoin. And one last thing on Bitcoin, because it is important in terms of, is this market looking bullish? And it's bullish when it's not just Bitcoin moving, but also the other cryptos moving, right? And so there is something called market cap dominance. So most kind of Elliott guys who also look at crypto would also look at market dominance chart. And obviously when Bitcoin began, it was 100%. Of course it was. It was the only instrument out there. But as you had Ethereum and Cardano and Ripple and all of these things, and Solana came in, the dominance of Bitcoin has been falling over time. And even though, we've had all of these, ETFs coming into the market, for Bitcoin only, the actual dominance of Bitcoin has not improved in any way. In fact, it's probably gone slightly down. And what does that show? It shows that, other instruments perhaps are receiving more dominance in the crypto world. So here's Ethereum. That looks like a triangle. So you talked about sort of entry levels. Here's an interesting entry thing for Ethereum. A rule of triangles is, A, B, C, D, E. This is just the dominance. This is not the price. But if Ethereum is likely or to rally, then most likely its role in the crypto world will be more and more important, and therefore it will have a much more important percentage of the whole crypto market. At the moment, it says it's roughly 17%. And if this really is a triangle, as I've labeled here, A, B, C is the complex, C is complex, D, E. And as long as E doesn't cross C, the low here, then that's a pretty good entry level of effectively being, and how would you take this? Probably you'd be buying Ethereum against Bitcoin, most likely. So you'd put on that trade. And as long as that percentage doesn't go below that percentage, then that's a reasonable kind of bet, a reasonable opportunity. And here you can see another triangle took place. So you can use Elliott Wave, not just in prices, but also in other metrics. And the dominance thing is pretty important. And if Bitcoin does go down, and so my forecast here, my chart here interprets Bitcoin's dominance to fall over time. If that's true, what does it mean? It means that the entire crypto world is rallying versus Bitcoin. So imagine Bitcoin goes to 100,000. The rest of the crypto market would act like a high beta crypto. So Ethereum would be more important, Cardano would be more important, Ripple would be more important, Solana would be more important. And you would see these instruments outperform versus Bitcoin. But at the moment, you see this is all fairly sideways. And Ethereum hasn't yet confirmed. It's a good level to say this could be the point which launches the alternatives market or the Ethereum market, or it could be the point where the whole thing falls apart. And that's just something to watch. Where is the dominance of Ethereum at the moment? I'd say a key level not to break is 16.38, which is that low here. And that's an important level, when you'd have to sort of reassess what does this chart, is this chart correct or is it not correct? So that's another little sort of add-on for Bitcoin and Ethereum. Questions?
No, I'm absolutely gobsmacked because this way of the dominance, I never considered that.
It's a number of people look at it. It's not something that's obvious to many people in the crypto world because they only look at one thing and one thing only, because they are sort of only Bitcoiners or only Ethereum guys or only Solana guys. But it's very important to look at relative value, as you know. And there is only one pot for crypto, and the pot of crypto is either shrinking or it's expanding. So we could do a chart, an Elliott Wave chart, I haven't done it, on the whole market cap of crypto. Is that growing? And that's something I could do perhaps for another time. But here I'm more interested in Bitcoin versus the alternative world. And obviously that's like silver versus gold, or gold miners versus gold. What's the high beta bet that you want to put on? And therefore, if Bitcoin is the sole dominant, then all of these other things are going to fall apart. You're going to see more of these, cryptos go to zero. But actually, the way it looks the other way, that actually Bitcoin, you can see just on a Fibonacci retracement here. I mean, of all things, I've done a Fibonacci retracement of this wave, and look at it. It's sort of stayed below the 50% level. Went above the 38% level. It's, not sure if I've got this on probably not got a logarithmic. Would be good to have it log. So here, logarithmic. Thank you. It reached 50%, which is a good wave 2 retracement. And it's not going up, even though there are ETFs out there. And I think what that means is that Bitcoin will gradually play a lesser role in the crypto world, because utility is more in the other sort of, Web 2, Web 3 type cryptos. And that's an important thing as well. What do you buy? It's always the question, what do you buy? So there's Bitcoin, there's Ethereum. That's my interpretation of the two.
Oh, thank you very much for that.
So
we have to do more about this stuff, Nick.
Yeah, absolutely. I mean, this is a wonderful world, and S&P probably very quickly now. So again, this was my interpretation of the S&P. You remember our famous now, discussion around here. Okay, that's probably not the right thing, but this point here, 4,100, and we were watching this market collapse. And this was the Nick Sweat day.
Yeah, the 3 points, exactly.
403. So you can see this wave 4, as I had labeled it at the time, did not cross this wave 1. And that was for me like a wonderful thing, because it allowed me to call it wave 4. Now, the way that I have labeled this thing, we had a correction, interest rates higher, everyone forecast recession, liquidity bottoms at this level. Liquidity helps the financial markets. Financial markets start to rally. Where was this correction? We probably have the long-term chart here. Very quickly, long-term probably don't have it, maybe do. Yeah, so this, okay, this is not, I haven't finished it. I had to redo all my charts. But anyway, what I talked about, wave 4 corrections, this wave 4 has sort of corrected in the previous wave 4 here. These things you see very often, and it sort of gives you always a guide. So this wave 4, I labeled it as wave 4, and now I'm counting. So I count, and then I counted 1, 2, 3, 4, and if we can, I've got it on a 2-day thing here, put it on a 1-day. So I counted, and I'm looking for a high somewhere around here. So I counted 5 at that point. So I think I counted 1, 2, 3, 4, 5, and then I said, okay, it's got to be over. Of course, it wasn't. Wave 3, wave 4, and I'm counting again the subcategories of wave 5. So on this basis, here's another thing. Firstly, is this count correct? 1, 2, 3, 4, 5. Could I count it better? I can see another way to count it. We'll discuss that in a minute. But this is an interesting point. I've again counted to 5. Now, there's a sort of a practical way of using Elliott. Just because you can count to 5 doesn't mean it's the end, because waves can extend and all of this thing. So, you can see wave 1 here was very long. Wave 3 is shorter, and wave 5 is shorter. It's kind of a wedge. It's not really a wedge under Elliott rules because there's no overlap here, but it looks fairly wedgy. And, it's reached an interesting level. What's that interesting level? So when we go back to this, if we make the chart a little bit bigger, so this moved down from the January 2022 high down towards the October 22 low when liquidity bottomed, and it formed a base, and we started to count bullish then. So here we are. And we said that when you go past the 78% retracement, so you like the market, you're going past this retracement, you say, okay, where did 78% fall? And 78% basically was here. When did you break this thing? You broke it up here. You know that this thing, of course, you had a correction, you have to count, you have to buy at the right time. You know this thing is ultimately going to be targeting at least 127.2 to 138.2. Where are we now? So here we are in this range. And, it doesn't have to stop here. But this is, again, if you were sort of picking a point, you'd say, okay, I'm looking now for a great entry level. And so I look for my retracements. I do my counting. I look for my wave 4 retracements. I think wave 4 should end somewhere in the previous falls, So you might have been buying it here. You certainly don't want an overlap here. So you've bought it here. You sweat like I did. You have your early entry level somewhere around here. You sweat. It didn't break the very significant point here. And the market went up. And with your bull call spread that it's going to target 127, 138.2. And here we are.
So does the trend channel you have in there any meaning now hitting the extension at 123.6?
Well, generally, trend channels within Elliott are very important. But this is not drawn as an Elliott Wave trend channel. This is drawn as a technical analyst trend channel, not an Elliott Wave trend channel. So any experts out there would say, hang on a minute, Nick, that's not the forecast for wave 5. You're absolutely right, because an Elliott Wave trend channel does look differently. And the reason is because the base of the channel on an Elliott would be waves 2 and 4 joining, and then the parallel lines up. So that's, something different. I haven't drawn it because it was clear they were not relevant for me. But if I try to draw it now and see what significance that has, I'm trying to sort of get to this level, you can see we way past this thing. And, what does that tell me? That says, is this the only count that you can make in Elliott? So I know from a Fibonacci level, I've reached a reasonable target, even if I've counted it wrong. So I look at another count and I say, okay, how about something like this? And I do this kind of thing and I say, oh, what about if this is 1, 2, and then this is wave 3? And then I try to count wave 3 in the following way. I go 1, 2, and then 1, 2, 3, 4, 5. And I say, oh, that's my wave 3. And then this is where I think when we did our video, the automatic Elliott Wave thing counted it like this. And I may be mistaken and doing it an injustice. But you see here, this wave 1, which is the green wave 1 and green wave 4. Green wave 4 is not allowed to overlap green wave 1. And you can see this green wave 4 has overlap. So this would be an incorrect count, an incorrect interpretation. But I think that was what was being shown by the by the machine at the time. It's since corrected itself because I have checked it. And this is another alternative, which I don't dislike. Here is that significant low again. Wave 1, correction wave 2. Wave 2 corrected at 50%. Beautiful thing. Then we had another wave 1. Wave 2. This wave 2 corrected 61.8% of that wave 1. Another beautiful thing. So this, now we're looking for wave 3. Wave 3, I'm looking for ratios of versus wave 1. And at the moment, where, I'd look for 100%, 1.382, 1.618 as possible targets for wave 3. Then I would be looking for a wave 4. So we're in this zone. We know that based on the Fibonacci of that previous move, we know that this is a good target level. So it could well be not a bad point to put that wave 3. I can certainly count 5 waves. It's not textbook, but it's certainly countable. It's still the legal way. And so then we have a wave 4, and then we have a wave 5, and then we have a wave 4. You can see why I'm ultimately long-term bullish for stocks, because I still believe that ultimately there's more juice in this market, and this is not a bad interpretation of what's going on. And the issue is, is this thing over, or have we got to have a few more squiggles? And remember, the very important thing here is this sort of retracement level, Fibonacci extension, this zone. It's in this zone. So it's a good target level, for a top somewhere between, this 5,250 and 5,450 it looks like it should stop. And there I would use again, what other tools have I got that sort of guide me with this thing? And then I say, okay, have I got something, telling me an S&P cycle? Well, I've got a daily S&P cycle, which is turning down. I've got a weekly S&P cycle, which is still providing energy on the upside. And this is the battle that these cycles have with each other. And, it's very difficult. So you say, okay, do I get one confirmation from cycle? And the answer is no. So therefore, I have to go back and stick to my Elliott wave. And I'd say this interpretation is plausible. This interpretation is plausible. Both I like. And what does it say to me as a roadmap? It says, are we at the start of a bullish market, or are we at the end of a phase? Would I be putting money into the S&P at this level, or would I be taking money out the S&P at this level? And you can see that when people started to get bullish on the S&P was when all of these analysts changed their forecasts on no recession. They were buying at the beginning of this year, end of last year. And we've had a good rally since then, gone from 4.6 to 5.2. It's a 10% profit for these guys. Maybe they do start to unwind. Don't know. But I certainly don't see this as an acceleration point for the market. I prefer the interpretation to say, we're either sort of at the end or very close to the end, because we're in this Fibonacci retracement range.
We could say, if the long-term wave count is intact and there's much more juice to the upside, what we see on a temporary basis at the moment is room for consolidation, right?
Yes, I'm still recommending buying dips, because I still believe S&P will rally for at least another year and a bit. So I still see positive market for equities. And partly that's driven by macro, and partly that's driven by, you can't argue with the fact that earnings are supporting, stronger prices. And when you start to see the earnings fall apart, get out.
A very good point. I was listening to a podcast earlier today from Thoughtful Money, and Adam Taggart's sidekick, I forgot his name, unfortunately. He had an article published. I'm going to try to find that, about the importance of stock buybacks. And he was talking about that the blackout period for stock buybacks is kicking in within the next couple of weeks. And he elaborated on, because he mentioned the earnings, what earnings would actually look like, earnings per share, if we wouldn't have this huge impact on stock buybacks in this whole scenario. That would actually fit nicely in with a thesis of now being into getting into consolidation until the buyback blackout is over again, and pushes us into, well, the final leg, let's call it the final leg of the long-term upwave in here. So if I would have to set up a trade now, consolidation wise, what would I do? Shorter term, maybe 50 days, sell a 5-4-50 call spread, a narrow one on top.
So as I said, the best Elliott Wave trade setups are, for me, when you are in a wave 2 and looking for the end of wave 2, or in a wave 4 and looking for the end of wave 4. The moment you start to do, the human thing, when you sit in front of a screen, you want to do something, you say, oh, it's got to be, that's got to be it. I mean, I've shorted Apple, but that's it's a very kind of brave thing to short into a bull market. So the safer bets for trading and entry points are look for the sensible support levels of wave 2. Look at it, 61%, 50%. Those are beautiful things. And the same thing for wave 4s. Where did it retrace of wave 3? What percentage? And going back to this 78% extension levels. Technically, you're right. You would sell a call spread up here, with this 5 to, 60 to 5-400, something like that, 5-450. You'd sell that call spread. I mean, or you do a butterfly. I mean, but the point is, it's very difficult and has a sort of a less kind of hit rate than you would do if you were looking for these much easier trade setups, because they're certainly less painful. But once you get into this kind of Elliott thing, then yeah, I mean, you'd feel fairly brave. I mean, I'd do it, with small money.
No, it's the perfect Bayesian setup. Yeah, Elliott Wave gives me an indication that we're looking a bit. I don't want to call it topish, consolidation wise. So if I sell a 15 delta over the top, I have statistically, just out of the option math, only a 15% chance that that I will start losing money on the call spread. And at the same time, if the count is correct and we have the consolidation, I already have my target zone to close the position out again at 4961, if I interpret that correctly.
Indeed. I mean, you've already got the straddle on, since your bet.
Yeah, I've hedged now my delta.
Okay,
that
right.
is doing nicely. So it would work actually in my direction now. I'm delta
Absolutely.
neutral at the moment if we would go into consolidation. Yeah. So I could start buying back at 4961 then, because that would generate the delta again.
Indeed. But, when you look at S&P, the S&P is made up of 500 stocks. And, there are so many different pictures within each of these stocks. Apple, for me, still looks, different to Microsoft. And Apple looks, when I wasn't joking, when I said it, kind of, when I said it's a 3 trillion company. But if you said to me it's a 2 trillion company tomorrow, I wouldn't be surprised. And I'd say, yeah, that sounds about right. What's 2 trillion? About 120 in the stock price. I think that's doable. My view on Apple, where the stock chart is, and I sold it before this, Department of Justice thing. I thought this thing is really going to go to 120. I still believe that this company could actually lose, a third of its value quite quickly. But it's a view. It's a small bet. It's not a recommendation, but that's how I've interpreted it. And that chart looks totally different to some other stock charts you look at, where I'm actually looking at buying call spreads on, because they really do look like there's still a lot of upside for it. And maybe that's the positive phase in the market, where the old winners, as we talked about, sort of Mag 7, Mag 4, Mag 3, suddenly these things wane. And it's some of these other sort of things in the wings who are benefiting from, perhaps their own technology transition and margin improvements. And people are getting a fantasy for that as well. And those are opportunities to play. Whilst the index is going down, you start to see some smaller cap stocks or less cap weighted stocks actually improving. So that's the other thing you could start to look at, selling an S&P in some way, shape, or form, and against it as your hedge, if you like, in case you're wrong. Go and buy some other stuff that looks much better in the chart.
Well, at the moment, I have some. Let's call it a Texas hedge, contemplating at the moment about. Because, well, it
I
might as
remember
well.
those.
It might be, I'm gathering at the moment a very small portfolio for my students, just to have an idea. And it's always about purchasing power. So usually the stuff you do with a bigger portfolio, you simply are not able to do it, if you have a limited amount of cash. So I have a couple of aggressive positions in there in terms of collecting theta and selling some Vegas on the market, even though it's probably not the right time to do it. But I thought, what could I put in here which doesn't cost the world, but would protect me on the upside as well on the downside? And I thought, okay, fine. If the market goes absolutely nuts and does another 15% to the upside, I'll go in with a digital again. I buy a call 15% above the current level, I don't know, 90 days maturity, and sell the next strike above that, which cost me, I don't know, 5 cents in a dollar. So I could lose 5 cents, I could make $1 out of it. Barely any costs, protects me against the upside. How do you call that? Crack up, boom, or whatever it comes. And I'm also going a little bit lower and say, if we see a real correction, or testing a bear market, which is the level defined by 20%, I would do the same on the downside with the same ratios again. Cost me $3 to $4 or 3 to 4 cents on the dollar I could make out of that. So barely any premium in there. No massive reduction in purchasing power at all in the portfolio. And I'm insured in a way against two major crisis events: a massive correction or an insane push to the upside. Came across a statistic the other day. It's the 10 best first 90 days in the market, not 90 days, first January till the end of March or up to now. We have seen an all-time. So we're at number 9 or number 10, and 8 out of these former periods ended up with a massive positive edge at the end of the year, with unbelievable upside swings in the meantime. So when the market got really frothy, and I think Darius Dale said that the party gets the best just before the police arrives. Maybe we are there. So I thought, why don't I get in and hedge myself with tiny amounts of money against both this. Most likely these trades will lose money. They have a probability of 1 or 2% to actually make money, but it's a nice insurance portfolio, especially if you time it like you say, okay, fine, what could I lose in a market correcting 20%? Well, roughly 20% of my portfolio. But if this actually really happens, it kicks in as a nice insurance premium, which barely did cost me anything, which benefits of the very subdued VIX levels we still see here at the moment. And as well as I do, it's usually the insurance is the cheapest just before the house burns down.
Yeah, absolutely right. And the sort of government health warning here, what you don't want to do is to sort of keep buying insurance, because sooner or later, that becomes expensive. But you're right, that there are certain points where you say, you know what, the risk is higher now, and therefore I'm going to time the point where I'm going to buy my insurance. And I think that's, that's the skill that you've got. You've successfully managed to, do you an injustice by saying, without focusing on whether the market goes up or down, you're able to make money. What a wonderful thing that is, because other people have to learn how to sort of get the market right. And that's why I ended up learning Elliott Wave, because I didn't have that skill about how to make money without having that sort of, is it going up or is it going down kind of thing.
Oh, let me take off the screen and finish with a brilliant story I had, or a brilliant conversation I had with one of my very clever students, because he put on a hedge for his substantial portfolio. And then he said that he was quite sad that he didn't make any money on that hedge. I said, so do you have house insurance? Of course I have house insurance. I said, you're paying premium for that? Yeah, I pay premium for that. So you're sad your house didn't burn down? He said, no. I said, well, see it like this. That's why you take out hedges. And that put things a bit into a perspective, yeah, why we have these hedges on. We actually we want them to fail because we can make far more money if we're invested than to say, "Hi, I'm great, my hedge kicked in, but I lost money anyway, my house burnt down." So no, Nick, that was absolutely brilliant. We should do that more often. We had two assets in now, Bitcoin, which gave me already some ideas how to put on a tactical trade. It's a tactical brief after all. And the same true for the S&P we have here. We should look in far more assets. So if any of our viewers has suggestions, what would fit the mood of the time, put it in the remarks and we will have a look at it because we're always looking for good trades. And if you're interested in this, again, let us know. I'm pretty sure Nick, as a certified Elliott Wave specialist, analyst, is more than happy to share his know-how with you, to give you an idea. I always find it fascinating when we talk about this stuff, Nick. It's absolutely, it gives so much perspective about what is possible, especially as it's based on, well, investor psychology. What's all behind it? We're always the same crowd. We tend to do the same stuff. You had the analogy at the beginning with the swarm, with the bird swarm, or how do you call it? Flock of birds. How they move, and this really gives food for thought. Nick, do you have any last words for our viewers?
That was a marathon. That was very good. You're right. We should do this again. But I loved your analogy with the house insurance thing, because actually in the finance world, there is a guy who believes that, your portfolio should be 95% equity and 5% insurance, because it gives you the confidence to run equities, because you've always got something that's going to cover you when things hit the fan. And there is actually a fund, and I don't know the name, I can't remember the name of the guy, Mark something or other, from the US. And just that sort of perspective to constantly run insurance allows you to take risk a lot more.
Yeah, let's have that as final last words. Excellent, Nick. Thank you very much, and thank you for viewing us. Give us a like, give us a share. How long will we do today? That was a longer one, right?
That was a long one. I'm sorry about
that. No, absolutely fine. I love it. Thank you very much, Nick. Thank you very much, viewers. Bye bye. See you soon.
See you, Thorsten. See you, viewers.